we could share it. Anyway, so were you weren't here last week, right? When we on Thursday when we
I wasn't.
Okay, so I want to show you a couple things that you might already know, but I'll put them up there and see if they're valuable anyway.
Okay.
Just real quick, these are kind of general announcements about the course. So let me share my screen. There's Brad signing in. Let's see. All right, so here we are on the home page. Sometimes people miss these announcements, and I would say just make an effort to check them out. They kind of tell you what's going on for the next week. And I'm not perfect. Someone pointed out I made a mistake on the introduction this week. And I did that because the way it was set up, it showed these as midweek assignments and then these as end of week assignments. But if you looked more closely, the due dates were all on Saturday for these assignments this week. So that's my error. I was just going off of the way the module was built, not realizing the due dates are the same. So I'll have to adjust those to Saturday. But also the additional study content, I put together a little Google Doc in case any of you haven't seen this, that just has links to a bunch of videos and other little things I've made. You can reach it here. There's always a link to it in the introductions. There's also a link to it in the modules. So if I'm going to go click on modules right here, just kind of before you get into the weekly modules, there's one called Brother Fox's Helpful Stuff. One is a list of all the presenters. When people sign up for those presentations, I just put it into a spreadsheet. So if you ever forget which week you're supposed to present, you can find that there. And then the other is this additional study content I put together. And I add to, as people reach out and say, can you help us with this problem or that problem? So like we're on chapter 2 this week. So really all I have recorded is an overview, which is actually what we're going to go through in this meeting. And then a little study guide for debit and credit rules. But for example, if people are working on quiz access and they get stuck and they email me and say, hey, can you do a video? When I can, and it's, well, I guess I do have several. So if you're stuck on a problem in the quiz access, check here first, I guess is what I'm saying, because these are little videos of problems 5, 6, and 9. Those are ones that people asked for help with before. So I want to make sure people are aware that's there, because I'll find people kind of like struggling with something, and then they'll ask me, and it's one that there was already a video for it, and they're like, oh, that would have been helpful to know. So just want to let you know. Anyway, so that's that. So before I kind of launch into an overview of the concepts of this week, are there any general questions? So not so much about specific content of a problem or something, but more like overall course type questions? Okay, that's good. So let me pull up. So I usually try to keep these short, these little presentations, but this week there's a lot of new content, and so this has more slides than I love, but most of them are like they're like examples, or like us walking through several examples. So this is where we get into the whole idea of an account, that the name accounting comes from. And again, I apologize. I have a little bit of a cold, and so if I sound stuffy to you, it's because I am stuffy. I wasn't just making my voice this way to be cool. Anyway, so an account is just a record of increases or decreases, okay, for a specific type of financial thing, either an asset, a liability, an equity, a revenue, or an expense. So those are your 5 categories of accounts. You'll find out, you probably already are finding out, that the math isn't super hard in accounting, but the whole classification of things into which account do they belong with can be confusing. And that's the thing that usually creates the most confusion. So a general ledger is a record of all accounts used by the company. I guess you could have read that, but that's what a general ledger is. So I also want to put out there that while I'm going through this, please don't think of it as a static thing where you can't, like, if you're like, have a question, don't be afraid to interrupt me and just say, hey, I have a question. I don't want anybody to feel like, it's so hard on Zoom to recognize sometimes when somebody has something to ask or say. So if you just jump in, I will not be offended. I won't throw my pen down in disgust. I'll just answer your question. So that's the definition of an account and a general ledger. So asset accounts are things that a business owns, okay, that we use for the purpose of doing business. And so the most common asset is cash. Every business needs cash to operate. Accounts receivable, that is money that's owed to the business by customers. So a lot of times when you just say to a customer, hey, you can pay me in 30 days, that creates what's called an accounts receivable. Note receivable, this is money owed to the business, but in a more formal way where you've actually drawn up an agreement on how someone's going to pay you. And prepaid accounts, those are when you pay in advance. The most common one probably is prepaid insurance. A lot of us will pay our car insurance for 6 months at a time, something like that. So we're paying in advance. And that creates, and that creates an asset, so that creates an asset because we are owed the use of that insurance for the next 6 months or however we prepay it. And then things like supplies, equipment, buildings, land, those are a little more obvious what each of those things are. So those are asset accounts. Liability is money owed to the money that the business owes to someone else. So accounts payable would be money that the business owes to its suppliers. So if the supplier sells us things, goods, then and tells us that we can pay them in 30 days, then that's an accounts payable. A note payable, again, is money that we owe usually to a bank, most often, but it could be to an individual or someone else where it's just more formal. We've drawn up terms of payment and we owe them money. Unearned revenue is money that customers pay us in advance before we've delivered any goods or service to them. So if somebody gives me $5,000 for rent, and that's going to be $1,000 a month for the next 5 months, then when I get that money, I record it as an unearned revenue. That's a liability, meaning I owe them. And then as they rent the space each month, I'll reduce that unearned revenue and I'll record it as a earned revenue because I've now earned it. And finally, accrued liabilities, those come up as we owe money to people over time. So a good example of this would be each day our employees work, we owe them money for the work they've done that day, but we're not going to pay them until payday. And so we have an accrued liability for, it's called salaries and wages payable, that accrues or adds up each day they work. And then on payday, we pay it off by paying the people. So those are the liability accounts. Finally, we have equity accounts. And equity is a little more confusing, I guess, because it's equity just means really it's the part of the business that the owners actually own. And so what I mean by that is that can come up from money either being paid in by the owners, that's called common stock. So when the owners of a business start a business, they usually put money into it. And then as the business grows, sometimes they put additional money into it. So that's, and that would increase our equity account. We also have the revenues, the money that the business earns are going to increase our equity. And the expenses, the costs the business pays, are going to decrease our equity. And then finally, dividends, which are shares of the money, the profits the business earns that are paid out to the owners, those will also reduce our equity accounts. So already this probably feels like a lot, like I'm just throwing a whole bunch of new information on you. You've probably been looking at it a little bit this week. So don't get overwhelmed by it. It becomes easier the more you use it. So what we need to know is that assets always equal our liabilities plus our equity. This is called the fundamental accounting equation. Assets equal liabilities plus equity. That's a basic rule of accounting. So if an asset is what a business owns, then that's going to either add up to debt that the business owes, or equity, the amount that the owners own. Okay. In other words, there's really only two ways a business can purchase assets. It can either borrow the money, or it can have its own money. That's it. And so our assets will always equal our liabilities plus our equity. So this chapter also introduces the idea of debits and credits. And the terms debit and credit are confusing because for most of us, the experience we've had with the terms comes from banking. We have our debit card or a credit card, but we're not exactly clear what it means. Usually we think a credit increases our account at the bank and a debit decreases our account. But those names for it they make it more confusing than it is. Okay. All debit means is something entered on the left side of a ledger, and all credit means is something entered on the right side of a ledger. That's it. Debit means left, credit means right. One doesn't mean increase or one doesn't mean decrease, because some accounts increase with a debit, but other accounts will increase with a credit. So any attempt to try to think of it in terms of one's an increase or one's a decrease is confusing. Just think that debit means left, credit means right. Okay. And then we have to learn the rules of the different types of accounts, and then we'll be able to figure that out. So here are the rules. Asset accounts, they increase with a debit and they decrease with a credit. And then liability and equity accounts are the opposite. They increase with a credit and they decrease with a debit. Why, you might ask, is that the rule? Well, because the Italian monk who created this in 460 AD, I don't remember his name, sorry, because those are the rules he came up with, and it works. And so the system hasn't changed fundamentally since then. And so we've been using this double entry accounting system since 400 and something AD. And so what I tell people is it's kind of like times tables. You just have to sort of memorize this and remember, assets increase with a debit, decrease with a credit, and liabilities and equity, they're the opposite. They increase with a credit, decrease with a debit. That's not a huge amount to memorize, and as you work with it, it'll come pretty quickly. You'll also see these sides of the account labeled as normal. What normal means is it's the side of the account we would expect to see a balance on. And if you're quick on the uptake, you'll see that the normal balance is always on the side that increases the account. So if an account has a balance, you don't usually have negative assets. Okay, you either have zero assets or a positive balance of assets. Same with liabilities, same with equity. So just remember those rules. Assets increase with a debit, decrease with a credit. Liabilities and equity increase with a debit. I'm sorry, increase with a credit and decrease with a debit. So confusing, right? And then the normal balance is the side that increases the account. When I was showing you a minute ago in the additional study resources or additional study content, there's a little, I used to call it a cheat sheet, but the name cheat just sounds bad. So there's now I call it a study guide, but it summarizes this information for you. You can use that when you work on your homework if it helps you, but you can't use it on the exam. So remember, it is just a tool to help you remember that. So, but that's there in the additional study content for you. So this is a couple more rules. We didn't cover these three special types of accounts: dividends, revenues, and expenses. They all relate to equity, but they have some weird relationships. So dividends and expenses, they both decrease our equity account. So their rules are going to be the opposite of our regular equity account common stock. Okay. So we increase with the dividends increase with a debit, decrease with a credit, expenses the same way. And then revenues in common stock increase with a credit, decrease with a debit. So honestly, this is what you're going to have to memorize is these 5 types of accounts and which side they increase with and which side they decrease with. And then just remember that the normal balance is always the side that it increases with. And that just takes some practice. The other day, my wife was braiding my granddaughter's hair, and I asked my wife if she missed braiding the girl's hair because my girls are grown up. And she said, I kind of miss it, but I'm just not good at it anymore. And my 4-year-old granddaughter said something that I don't think she realized was deep, but it was. She said, it's okay, Grandma, if you're not good at it. That just means you need to practice more. And I thought, in a world where everybody has this external locus of control and feels like, the world is just so hard and things are impossible, the 4-year-old gets that if there's something you're not good at, all that means is you need more practice at it. And that's been my experience. Things that I'm not good at, well, I just need to do it more until I get good at it. Probably the reason I'm a little more confident in accounting than you is because I've been doing it longer, not because I'm smarter than you, not because I have any special knowledge or anything, just more practice, right? Just like it's quite likely you could teach me things that I've never done, and I would take practice for me to get good at them. Like the guitar, I'm terrible. It hurts my fingers because I don't practice enough. Counting hurts my brain if I don't practice enough. All right. So here's an example of what's called a T account. Okay. And this is how we can figure out the balance of an account. So it's set up this big T right here. And the left side is our debit and our right side is our credit. So this is the T account for what's called for cash, for the cash account. And so each time cash was increased, they debited the account. 30,000, they received an investment from the owner. 4,200 for consulting service revenue that they earn, 1,900 for collection of accounts receivable. And then they credited the account each time something reduced the cash in the account. So when they purchased supplies, purchased equipment, paid rent, etc. And you'll see that if we add up everything on the debit side, it adds up to 36,100. We add up everything on the credit side, it adds up to 31,300. Then what you do is you subtract the larger side, or you subtract the smaller side from the larger side, and that leaves you with a balance. And if the balance, if the larger side was the debit side, then the balance would go on the debit side, and we would say the cash account has a debit balance of $4,800. That's the terms we would use when describing that. What that means is the business has $4,800 in cash. So increases because it's an asset, increases on the debit side, decreases on the credit side. And then to find the balance, you just subtract the smaller from the larger, and that's your balance. All right, so this is called a journal entry. The journal entry, there's a lot of arrows pointing there, okay? But so it has the date of the transaction. It has the accounts that are impacted. And you'll notice there's always a debit and a credit, and that they always equal each other. So every entry has to balance. So for example, this first transaction on December 1st, the owner paid in $30,000 to the company. In real life, that honestly means the owner took $30,000 out of their own personal checking account and put it into the company's checking account. That's how most people start a business. So to do that, they show an increase to the cash, the debit the cash, and an increase to the common stock. And remember, because common stock's an equity account, it increases with a credit. So there's a debit of 30,000 to cash and a credit of 30,000 to common stock.
Sorry, quick question. What's the PR?
PR. That is the reference. So, and I don't know why they have this on here. In the good old days, when you would do a handbook, you would keep a reference for each account on a separate page in the book. And so then you would write down that page reference for each one. We won't be doing that. Everything's done with computers now, but if you see an old ledger book, that's actually how it's listed out by page. And then in the second transaction, they purchased some supplies for cash. So you'll see the asset supplies increasing or being debited 2,500, and the asset cash decreasing and being credited 2,500. So this is why it's called dual entry accounting, because there's always a debit and a credit, and they always have to equal each other. Sometimes you'll have what's called a compound entry. I'll show you an example in a minute, where there's more than one debit, but the values still have to add up, and I'll show you what I mean in a minute here. So I showed you a T account a minute ago. This is similar to that, except it shows the debit and then it keeps a running balance. So this is what we usually call a balance column account. So the account was debited 30,000, has a balance of 30,000, then it was credited 2,500. So the new balance is 27.5. Was credited 2,600, so it has a new balance of 15, etc. And so this is just the process you go through. Every time we make a journal entry, especially when we used to do it by hand, you'd write out the debit, and you'll notice the debit entry is always listed first, and then the credit entry. And then we would post that journal entry into what's called the general ledger, which is just where we keep track of the balance of each account. And so if you think about it, the journal is this chronological. Each time we make an entry, we're going to record the date and which accounts are changing and how much they're changing and in which direction. And then the general ledger is, instead of being listed by date, it is listed by account. And so it's the balance of each account. Okay. All right. So I think this is the part that really matters. And this is kind of the bulk of this little discussion is this process of going through the transactions. Okay. So there's a process. This is how the book explains it. So I want to stick with their process. So their process is that we identify transactions and the source documents. So in real life, that means we would have a receipt or an invoice or something like that would be our source documents. Then we would analyze the transaction using the accounting equation, then record the journal entry, and then we post the entry. So that's the 4 steps. So let me just take you through some examples, and I think that will become clearer what I mean by that. All right, so here's our first transaction, brand new business, and we receive an investment from the owner. So we receive $30,000 cash from Chaz Taylor. Chaz sounds more hip, in exchange for common stock. So the first thing we want to do, the first thing I do, when they say analyze, what I do is I say, okay, what accounts am I dealing with here? Cash account and the common stock account. What's happening to each account? Well, cash is going up because money's coming into the business. Common stock is also going up. And then apply the rules. And I say, okay, well, cash is an asset account. Assets increase with a debit. And common stock is an equity account. And common stock or equity accounts increase with a credit. That's what I think they mean by analyze, is saying what accounts and kind of what direction are they heading, right? Then I can make my journal entry, a debit to cash of 30,000, a credit to common stock of 30,000. And then finally we post it to our journal, or I'm sorry, post it to our ledger, whereas cash now has a balance of 30,000 on the debit side, and common stock has a balance on the credit side. So the next transaction, pretty standard transaction for businesses. We're going to purchase some supplies for cash. So again, I would ask myself, what accounts, cash and supplies? What type of accounts are they? They're both assets, something that we own. And then what's happening with them? Well, if I'm purchasing supplies, that means my supplies are going up and my cash is going down. So then the rules, assets increase with a debit. So I'm going to debit supplies 2,500 and I'm going to credit cash 2,500 and then post that over to my my ledger. Here they purchase equipment for cash. Again, cash and equipment, both assets. So as one asset goes up, another asset goes down. Equipment's going to increase, so that'll be a debit. Cash will decrease, that'll be a credit. You'll find out real quick as you do more and more of these that there's only a few things that can happen, right? Like if an asset goes up, then some other asset had to go down to pay for it, or a liability had to go up to pay for it, or an equity had to go pay for it. I guess the owner could like put an asset into the business. That's about it though. And so it becomes pretty limited when you remember assets have to equal liabilities plus equity. There's only a few things that can really be happening here. Here we're going to purchase some supplies on credit. So when they say purchase them on credit, it means we're not paying cash for them. Instead, we're going to have a liability or a debt for them. So we'll see, I say I have assets, supplies going up, and then a liability amount that I owe is also increasing. And since assets are increased with a debit, my debit will be 7,100, and liabilities are increased with a credit, my accounts payable liability will also increase by 7,100. We provide services for cash. That means we're doing our work and someone's paying us. And so if someone's paying us, our cash will be increasing. And our revenue, that means money we earn by doing business, will also be increasing. Cash is an asset account, so it's increased with a debit. And revenue increases equity, and so it's going to increase with a credit. So the hardest part about all this is remembering the rules, right? Remembering which type of account each account is, and then applying it, saying, okay, what account am I dealing with here, and what is the rule for that account as far as the debit or credit rule? That's the hardest part. The math, we haven't done any hard math. So don't let the math scare you. It's the filing and sorting of things, so to speak, that can get challenging at times. We pay for an expense in cash. So our cash is going down and expenses are a decrease to equity. Okay, so the rule so that means, but when we pay an expense, we say that our expense is actually increasing. So expenses increase with a debit, and decrease, and cash, an asset, decreases with a credit. So that entry right there. And so this is what we're starting to get into, where we see how accounting is kind of its own little language. It's not a complex language compared to, say, Mandarin Chinese or something, but it's still, an accountant could see this and know exactly what that means, which means the company paid $1,000 cash for their rent. But until you get used to it, it still seems a little bit, I guess, just like, what does that mean? Or a little confusing. We pay an expense, another expense paid in cash. So we have cash decreasing. And then, see, I feel like this is confusing the way they did this, because it shows a negative 700. That's because expenses decrease our equity. But we would say that the expense account here is increasing. I think that's what's confusing about that. So our salary expense, we debit 700 and we credit cash 700. So we're paying $700 for our salary expense. We provide consulting and rental services on credit. So this is now, we're providing services to people, but we're not getting paid cash. Instead, we're getting paid the promise of payment in the future. So whenever we get paid on credit, that means our asset accounts receivable is going to increase. That's money owed to us. And then we have two different revenue. We have a consulting revenue that's increasing by 1,600 and a rental revenue. So here's our first compound entry. We can see there's actually three different accounts being impacted, but you'll see the debit side still equals the credit side. That's the rule. They always have to, the debit side has to always equal the credit side. So accounts receivable, an asset increases with a debit, and then our revenue accounts are revenues and they increase with a credit. Here is when someone who owes us money pays us, so receipt of cash from accounts receivable. So now we'll have our asset cash going up and our asset account receivable going down. It's no longer owed to us because now we've received the cash. So we'll debit cash 1,900 and credit accounts receivable 1,900. So many of these. All right, here's a partial payment on our accounts payable. So we pay $900 cash toward the payable. And so here you can see our cash is going down because we're paying 900 in cash. And our liability or debt is going down by 900. So since liabilities decrease with the debit, our debit entry will be the account payable, and assets decrease with a credit. That's how we'll set it up. Pardon me, sorry. Here we can see our account payable. We had a credit balance of 7,100. Now we've paid 900 on it. So if we wanted, we could figure out the new balance of that account, which would be a credit balance of 6,200 after that payment. But usually we don't add them up until the end of the period. Here's a payment of a cash dividend. All a dividend means is a share of the profits a business makes that we pay to the owners. I mean, that's why we have a business in the first place, right? Is so that we can make some money. So when we pay a dividend in cash, our cash goes down and our dividends. So this, like the expenses, it looks confusing because it reduces equity, but we would say our dividends increasing by 200 here. So dividends increase with a debit entry and our cash, our asset decreases with a credit. Here we receive $3,000 cash in advance of providing consulting services to a customer. So our cash goes up, that's our debit. And then our unearned consulting revenue, which is a liability, money we owe. We either are going to owe them the money or the consulting services we promised. And so our cash will increase by 3,000 with the debit, and then our unearned consulting revenue will increase with a credit. Then in the future, as we provide those consulting services, we'll debit the unearned consulting revenue account for the amount we provide, and then we'll credit our revenue account because now we've earned that money that we received. A couple more, we're almost done here. Here we pay $2,400 cash for insurance coverage for the next 24 months. So our cash is going to decrease and our prepaid insurance asset's going to increase. And so we know that an asset increasing is a debit and then another asset decreasing is our credit. And then we pay cash for supplies. Again, our cash will go down, supplies will go up. They're both assets, so we'll debit supplies, credit cash. A utility expense, again, cash goes down. The expense is going up, which reduces our equity. So we're going to debit the utility expense, credit cash. There's another payment of expense, our salary expense, same idea. Debit to the expense. You'll see this is one of the most common entries we make. If you think about a real business, is this debit to the expense, credit to cash as we're paying our bills, right? That's just a really common thing to happen. Okay, so at the end of the accounting period, we have this ledger now that has all of these transactions, but listed by account, and then a balance. Again, we found the balance by adding up both sides subtracting the smaller side from the larger side. So at the end of the period, we have $4,275 in cash, the debit balance. Our accounts receivable has a zero balance. Whenever there's a zero, you'll see they put it on the normal balance side. That's the side, normal balance is the side that increases the account. We have a 9720 debit balance in supplies, 2,400 in prepaid insurance, 26,000 in equipment, 6,200 credit balance in accounts payable, $3,000 credit balance in unearned consulting revenue. And then we have our common stock. That's the money the owners put in, and the dividends, the amount we paid out to the owner. We have our revenues and our expenses. So this is a summary of all the transactions in the ledger. We can use that to create what's called a trial balance. A trial balance just shows the balance of each account. So you'll see it split into two columns here, debit and credit, and then it's got the names of each of the accounts. So we just put those balances. So this really kind of nicely summarizes all of this information into a single page. And then we can use this as we create our financial statements. The financial statements are kind of this way that we, as an accountant, would communicate financial information to business owners or potential investors, lenders, those sorts of people. So once we have this trial balance, you'll see the trial balance is always listed in this order. Here's all the asset accounts, then the liability accounts, then the equity accounts, then the revenue accounts, then the expense accounts. They're always listed in that same order. And then you'll see the balances, the debit balance equals the credit balance. And that has to be, if something's not balancing, it means you have an error somewhere and you need to go back and figure out what it is. So once I have that trial balance created, then I can create my statements. So my statements are my income statement, my statement of retained earnings, my statement of cash flows, and my balance sheet. So an income statement summarizes all of the revenues and all of the expenses of a business for a given period of time. So for the one business, we just went through all those transactions. We see that they had consulting revenue plus rental revenue, which give them a total revenue of $6,100. Then they had their expenses. The revenue minus the expenses is what we call our net income. Sometimes people will call that net profit. That's the business, the money earned from operating during that period. Then we have a statement of retained earnings, which has, well, there's the income statement. So the statement of retained earnings has any earnings or profits the business has made. So at the beginning of the period, since it was a new business, it had zero. Then you add any net income that they made, subtract any dividends, those are profits or earnings paid out to the owners. And at the end, you're left with the ending retained earnings or what. So the earnings the business made that they didn't pay out are the earnings that they've retained or held in the business. Finally, we have the balance sheet, which summarizes the assets, the liabilities, and the equity. So we have the balances of all of our assets, cash, supplies, prepaid insurance, and equipment, balance of our liability accounts, and then the balance of our equity accounts. And this number for retained earnings is the same number we calculated up here on the statement of retained earnings. You'll notice that total assets always have to equal the total of the liabilities and the stockholders' equity. That's because that fundamental accounting equation, assets equal liabilities plus equity, is always in play. A couple of ratios that they'll introduce you to in this chapter. The first is called the debt ratio. All a ratio means is a comparison of two numbers. So the debt ratio is the comparison of our total liabilities over our total assets. So to find that, we just take our total liabilities, which we would find on our balance sheet, divide it by our total assets, and that gives us our debt ratio. Think about it. If a business has as much debt as it has assets, then it would have a debt ratio of 1. because those two numbers would equal each other. So anything higher than 1 means the business has more debt, more liabilities than it has assets. Anything lower than 1 means that it has more assets than it has liabilities. So this is a ratio that lower is better. Higher indicates that there's more risk, more debt risk for the business. So here's an example. We have Costco versus Walmart. So Costco has a debt ratio of 0.7 in the current year. Walmart has a ratio of 0.59. So we would say that Costco has more debt risk, although neither of those look crazy high, but that's just an example of it. So that does it as far as a lecture period, I guess. And so at this point, I guess I would ask if anybody has any maybe questions from the homework or anything else you'd like to ask me about the topics that we're studying. And I know it's only Tuesday, which means we're just getting into it and figuring it out.
I actually thought this week's was a little easier, but I had a class that went through assets and balance stuff last semester. So the first set wasn't too bad, but I have just started the second set and I'm like 2 questions in and that's it.
Okay. Yeah, no, well, again, and I think what it is about this is it's really only hard because it's new, not because it's like crazy hard. You know, it's not astrophysics or something. But it feels like it when it's brand new to you and you're like have all of this stuff hitting you at once. But what it's the type of thing at the end of the semester you look back and be like, oh, I don't know why that seems so hard at the beginning, but it's just because it's new.
Yeah, I'm trying to remind myself of that because my class I took last semester scared me to death. And I thought, oh my gosh, I don't know this. But then starting this class, I thought, oh, I actually know a little bit of this already,
Right.
Just a little, but it is helpful. Gives me a little bit of hope.
Good. Okay, any other questions? I'm also very fine with us. You know, we don't have to take an hour every time. You know, it's just based on people's questions and needs, and you can always email me or anything if you need help. Also, I don't know if you all know it's there. I think most people do, but this little tutoring thing. So if you're in tutoring resources, this gets moderated by our course tutors, and they're usually pretty good about responding to stuff. And so, you know, you can post questions in here and they'll respond to you. That's another place. And you can also reach other students, because you know our class has like 50 students in it, but this is set up for all accounting students, and so there's like 30 sections of 50 students, and so this is a much broader group of people as far as like sharing information and stuff. And I also put a link to my little additional study help in here because I figure it might be valuable to students more than just the ones in my section. So I'm in Arizona, just so you know, I'm not up in Idaho. And so I'm cold because it's 63 degrees today. But they're cold because it's I don't know what it is in anybody in Rexburg. I have no idea. It's usually cold there.
It's only like 32 in Homedale and I'm on the other side of the state. So it'll be much colder in Rexburg.
Yeah, it's always colder there. All right, well, if we're good, is there anybody who would be willing to offer a closing prayer for us?
I could do it.
That'd be great. Thank you.
Our Heavenly Father, I'm so grateful for this chance to meet together as a class and to learn more about this subject. Please help us to continue to work hard and to retain what we've been learning and to understand it so that we can apply it in our lives. And I'm so grateful for the opportunity to learn and the good opportunity that BYU Idaho offers us. And we say these things in the name of Jesus Christ. Amen.
Amen. Thank you very much. Have a great night. Don't be afraid to reach out if you get stuck on something. And if it's something I think will help multiple people, I'll answer you and I'll post it to the additional study stuff. So thanks, everybody. And
Thank you.
have a good night.
Thank you.